Hi, everyone. This is Sanjib Kalita from Fintech Meetup. So happy to be with you here today. And I'm actually even happier to be here with our guest today. Kareem, would you mind introducing yourself?
Yeah, hey Sanjeev, good to see you. Kareem Saleh, founder and CEO of FairPlay. We cheekily refer to ourselves as the world's first fairness as a service company.
I love that. We've known each other for quite some time now. And I actually would be really curious if you could tell us how you got into this industry.
Yeah, well, I like to think of myself as having been a fintech person before fintech was officially the moniker. I've been kind of working on underwriting hard to score borrowers my whole career. Thin files, no files, people with some kind of credit event in their past, like a bankruptcy or foreclosure. I got started doing that work in kind of frontier emerging markets, so sub-Saharan Africa, Eastern Europe, Latin America, the Caribbean. And that gave me visibility into the underwriting practices of some of the most prestigious financial institutions in the world. And what I was quite surprised to find was that, even at the commanding heights of global finance, the underwriting methodologies that were used were quite primitive, certainly by Silicon Valley standards. Oftentimes 20 to 50 variables, conventional variables, almost all models built in Excel or with kind of logistic regression or conventional underwriting techniques. But of course, we know that today real decisioning is done in Python and R with alternative data and advanced predictive models. And so about a decade ago or so, I joined with some folks who had been at Google and at Cap One, and we started applying complex machine learning techniques of the sort that Google uses in search to the problem of consumer credit underwriting. And we found, I think at the time it was considered, revolutionary, but now I think everybody, regards it as the state of the art, that, complex machine learning techniques, alternative data, all of those can do a better job of painting a portrait of a borrower's ability and willingness to repay a loan.
Hmm.
And so I've been kind of on this consumer credit underwriting journey my whole career, but the last 10 years in particular focused on the application of AI and alternative data in consumer credit.
So much that I want to ask. Uh, one thing that maybe we'll get to later was sort of the difference between um, risk assessment in like places like sub-Saharan Africa versus the United States. So maybe let's put that aside for a second. But having worked at like a large bank in a credit card business, I know that there are a lot of regulatory constraints and concerns when looking at the types of models and the types of data, a lot of explainability, a lot of issues around what you can and can't use. How when you started this, like, how did you go about navigating all of that?
Yeah. So I think that one of the advantages of having been early to the application of AI in consumer finance was that we were also early to the regulatory challenges that attend the use of black box models and alternative data sources to make high stakes decisions about people's lives. And so I think, understood pretty early on that there was going to be a very heavy emphasis on explainability, a very heavy emphasis on transparency, a heavy emphasis on adverse action. So if you decline someone, can you tell them with specificity why you decline them and put them on a path to being approved in the future? And that there was going to eventually, over time, in a world of AI where it was possible to generate many different variants of a strategy, some of which would be functionally indistinguishable from an accuracy perspective, but very widely on other dimensions like fairness to protected groups, that you were going to need algorithmic fairness techniques to be able to identify blind spots in your models and attempt to correct those blind spots with a view to doing a better job of risk ranking populations that might not be well represented in the data. I think conventional underwriting techniques do a great job of underwriting a consumer if the data about them is present and correct. But of course, for so many Americans at the bottom of the economic pyramid, their data is more likely to be messy, missing, or wrong.
Hmm.
And so I'm a banking lawyer by training. And so we spent a rather considerable effort the last 7 years or so, making sure that the application of our AI techniques, the application of alternative data could be done in a way that was compliant and, wouldn't pose a threat either to the safety and soundness of the institutions that were using our underwriting methodologies or to the consumers they serve. And so our tool at a high level allows anybody using a predictive algorithm to make a high stakes decision about someone's life to answer 5 questions. Is my algorithm fair? If not, why not? Could it be fairer? What's the economic impact to our business of being fairer? And finally, did we give our declines, the folks we rejected, a second look to make sure we didn't deny somebody an opportunity they deserved?
And as far as FairPlay's customers, like how what might be some of the what would have been some of the results or benefits that they've gotten from using these 5 tools
Yeah.
or five
So our
questions? Yeah.
our customers are able to increase their approval rates on the order of 10%,
Mm,
increase their take rates on the order of 13%, and increase their
mm,
fairness to historically underserved groups on the order of 20%. So good for
mm.
profits, good for people, good for progress.
And the this is obviously like 10 years is a long journey. What is there what about the model? What about the tools are the same as what you envisioned, 10 years ago, and what's different?
Yeah. Well, I think, when we were very early to this business, we started basically experimenting with these AI methodologies in the wake of the great financial crisis. And at the
Mm,
time, we faced a cold start problem because we had not
mm,
been lending previously. And so we had to
mm,
go out and buy a bunch of data from some defunct lenders. And
mm,
and what we learned as a result of buying that data is that, machine learning algorithms are capable of learning the wrong things. And so, like, let me give
mm,
you an example. Yeah, one of the earliest models that we built when we got started down this path was built using it was using data from a lender that had failed. And we
yeah.
built our first machine learning model. We were extremely proud of it. And the model came back and said, "Hey, you should make loans in Arkansas." And
Mm,
we were kind of quite surprised by that. And it turns out that, like, my co-founder, just by coincidence, happens to be from Arkansas. And
mm,
he happened to know that the regulatory regime in Arkansas was quite hostile to these kinds of loans. And so
mm,
we dug into it, we tried to understand, like, why does the model think we should make loans in Arkansas? Well, it turned out that the data set didn't include any loans from Arkansas, which
oh
meant
my God.
that the model had never seen any defaults in Arkansas, which led the model to conclude that loans never went bad in Arkansas.
Wow.
It was through experiences like these that we came to understand the importance of rigorous explainability, rigorous stress testing, rigorous evaluation of the representativeness of the data. And then we encountered other problems along the way, right? So once upon a time, we were working with a subprime auto lender that was mostly active in the Western states.
Mm,
And that subprime auto lender had 2 variables in their model that at first blush seemed totally reasonable. The first variable was, what is the mileage of the car that is proposed to be purchased? And if you think
yeah.
about that, that's a totally reasonable credit signal, right? Like, the
Mm,
higher mileage the car, the more likely it is to break down. The more likely it is to break down, the more likely the owner is to miss work. The more likely you are to miss work, the more likely you are to miss your car payment, right? So, what is the
yeah.
mileage of the car? A totally reasonable variable to use if you're an auto lender. The lender also had another variable in their model, which was, does the applicant live in Nevada? It turned out
Mm,
that for whatever reason, Nevadans had a slightly elevated risk of default. I don't know, maybe there
mm,
was something macroeconomically going on in Nevada. I don't know if Nevadans are more risk seeking owing to their long history of gaming, but whatever it was, Nevadans had a slightly higher rate of default, and they were using that signal in their model. States are really big, no redlining concerns. Though both of those variables passed muster from a compliance perspective. There's only just one problem with that. If you're buying a high mileage car in Nevada, there's like a 70% probability that you're a person of color. So you think you're making decisions on the basis of state and mileage. You're really making your decisions on the basis of Black, Hispanic, Native American, et cetera. And so I think, that
Oh,
has
wow.
been, there have been so many lessons along the journey, right? Lessons about the need to validate the representativeness of the data, lessons about the need to explain the model's decisions and explain them in a fairly rigorous way, a way that that takes into account these multivariate interactions. And then, of course, the ability to search for variants of the models, which would perform within your risk tolerance, but maybe be less disparate to
Right.
women, Hispanic consumers, et cetera.
Wow. That's fascinating. And
I think the other
quite
big
surprised.
lesson, so
Yeah.
the other big lesson along the way, Sanjeev, has been that cash flow underwriting makes the outcomes of machine learning models even better. Cash
Mm,
flow underwriting, I think one of the biggest lessons of the last several years has been that cash flow underwriting is in some sense the truest measure of the consumer's balance sheet.
mm,
And
yeah.
so what we're finding is not only is it highly predictive of a risk perspective, but also minimizes disparities for protected groups.
Wow. That's great. And definitely quite a leap forward from what I remember in my days at, in terms of like credit risk assessment. Hats off to you and the team for what you're doing. Um, I wanted to ask you about, I think obviously we've met over this year, I think in like 3 or 4 different locations. And one of them was at FinTech Meetup. I wanted to ask you what was that experience like?
I thought FinTech Meetup was fabulous. I think it was probably the single best kind of FinTech focused conference that we attended last year. I loved the double opt-in meeting structure. There's basically no place else that you can go and have a series of high value meetings with, 20 to 30 people a day, right? So do, on the order of 50 to 75 meetings in about 72 hours. And then of course set against the backdrop of all the fun there is to be had in Vegas. So I thought it was absolutely fantastic event, both the meeting component and then of course, the panels and the discussions, which featured very big names from some of the premier institutions, both in fintech and financial services. I think fintech meetup has become the must-attend event for those of us who are interested at the intersection of technology and finance.
Well, I love hearing that, and especially coming from you who has been in the trenches for 10 years. That's high praise, and I appreciate that. What are what sort of looking forward to like the next couple of years? How do you where are you taking FairPlay next?
Yeah. I think the thing that we're seeing is that like as predictive models take over higher and higher stakes decisions in our lives, once upon a time in financial services, it used to be that you really only assess the fairness of your decisions with respect to underwriting and pricing. And all of this stuff really started kind of in the mortgage market, where America has an unfortunate history of financial exclusion. But I think what we're finding as the ability to use AI across the customer journey gets democratized, you start to have to pay attention to, is my marketing fair? Is my fraud detection fair? Is my income verification fair? Is my identity verification fair? Heaven forbid, are my loss mitigation and collections and claims administration's decisions fair? And now you have to do that not just in mortgage, but you have to do it across all of the asset classes, whether it's installment loans, credit cards, auto loans. even some of these products that have been structured not to be lending products, like earned wage access and buy now, pay later. So I think what we're seeing is with the advent of AI and alternative data, that the kinds of decisions that are being evaluated for fairness is growing. And consequently, the kinds of companies that have fairness obligations is also growing. So I think that's a future that we are looking forward to and that we're helping our partners navigate is how do we assure fairness across the customer journey, across the high stakes decisions that we make, so that we're not denying folks opportunities that they deserve.
Well, that's quite um, a huge opportunity, but it's also quite a huge responsibility as well. And I'm glad that you and the team have taken that on. I wish you best of luck, and thanks again for joining us today, Kareem.
Thank you, Sanjib. I look forward to seeing you and your colleagues at FinTech Meetup, I guess in just a few months now. Hard to believe it's already almost 2025.
Yes, thanks again. Take care.
Thanks, bud.